Hi, I'm Ben Mohr, Marquette's Director of Fixed Income. I'm thrilled to share with you our findings on the exciting and fascinating area of machine learning and its application within portfolio management. Machine learning is becoming a very important part of asset management today, and it behooves us as investors and fiduciaries to know more about it. Now, before we begin, I'd like to ask you two questions. The first is, do you use machine learning every day? Now, the answer should be yes, because for all of us, between Google searches, online shopping, checking the weather, we are all actually using machine learning every single day. The second question is, do you know how machine learning works at a high level? Now, the answer there, again, should be yes, because if you are an investor, you actually already know how machine learning works at a high level. And hopefully my talk will go towards showing you and supporting and encouraging that knowledge. Now, shall we begin? Here is a clip of one of my favorite movies from back in 1991 when I was in junior high school, Terminator 2, when sentient machines take over the world, complete with lasers and explosions. You can't have a Hollywood blockbuster without lasers and pyrotechnics these days, even in 1991. In this talk, we'll go through the history of machine learning very quickly, and then we'll dive into what machine learning actually is. And in fact, you already know how it works. Then we'll take a look at why we want to use machine learning for investing, its obstacles, and how it's actually being used today by asset managers. We'll conclude with future trends. We've come a long way, and machine learning has grown exponentially. Many of you will remember in 1997 when Deep Blue beat Kasparov in chess. Google released their first self-driving car in 2009, and Watson won Jeopardy in 2011. Since then, it continues to grow. Today, no less than 10 asset managers are using machine learning in their investment process. Some of those include AQR and Citadel right here in Chicago that we've met with recently to discuss their machine learning processes. Now here I want to make a distinction between AI and machine learning. AI, artificial intelligence, is using the machine to perform tasks intelligently. Machine learning is actually a branch within AI where the machine can learn on its own without supervision. I'll show you 3 cartoons in this talk. This is the best, and it gets progressively worse. With our low interest rate environment, here's an excuse you could use with your children, your grandchildren, nephews, and nieces. No, maybe that's a bad idea. Maybe just as a joke. Now, why are we hearing so much about machine learning over the last few years? What's making all this possible? The answer is big data, and I find this statistic just fascinating. Can you believe it? 90% of all data today was created in the last 2 years. That's mind-boggling. Here I want to make a distinction also between big data analytics and machine learning. Big data analytics is discovering hidden patterns and extracting insights in volumes of data where you need significant computing resources. Machine learning is learning without explicitly being programmed. Big data is enabling the improvement of accuracy of machine learning and its predictive powers. And as computers become more powerful, machine learning will be more useful and more accurate. Now, the moment you've all been waiting for. We'll take a look at what machine learning is, and you'll realize that you already know how it works. Behind all the smoke and mirrors, it's just probability, statistics, and regression, but amplified. Here is the basic building block of machine learning, simple linear regression. You all know as investors this equation, y equals alpha plus beta times x. Alpha is the excess return of your manager's performance above that of the index. Beta is the strategy's sensitivity to the index. X then is the index's return, and y is the manager or the strategy's return. To use this in linear regression, we take in all the historical data for x and y that we want to try to relate to each other. We plug it into the computer, and we figure out the average beta and the average alpha. Then going forward, once we're presented with real-time future x's as they come in, we can use that beta and alpha to determine y, to predict y, or to regress and obtain y. Machine learning uses this very concept at its core. Here, we'll train the machine to do things like facial expression or driverless cars. Here, we're helping the machine recognize a cat. So in the Y, we're going to train the machine and tell the machine that what it's seeing is a cat. On the X's side, we show it the various characteristics of a cat, the pointy ears, the whiskers. Now, an important point I want to make here is, while the machine can recognize the pointy ears of a cat and the whiskers of a cat, it can't recognize the feisty behavior of a cat. Now, I want to also finish with the fact that as the machine takes in these X's and Y's, the machine continues to learn and gets the alphas and betas, the average alphas and betas, and it stores those coefficients. Here's the amplification I talked about earlier, the deep neural network. A deep neural network is a common machine learning framework. It has hidden layers where each of these nodes are that equation that we looked at earlier, the linear regression equation, the y equals alpha plus beta times x. Each of these nodes interact with each other, and it captures the second, third, and fourth order patterns for better accuracy. Now here we're going to use the machine and we're going to train it to learn to recognize a cat using the deep neural network. This is the same concept as before, but we're just using the neural network. We show it the image of a cat, and on the right side we tell it this is the cat, that's the Y, and it recognizes each of the characteristics of a cat that are the X's, the pointy ears, the whiskers. Additional characteristics could include a furry paw of a cat or a long furry tail of a cat. Now that previous step was step 1, where we train the machine. Here in step 2, we use the machine to predict. We use the machine to tell if what it's seeing is actually a cat or not. Here we show it a picture of a different cat. The machine can see the pointy ears, it sees the whiskers, and because it's got all this stored through its alpha and beta coefficients, it can recognize that this is a cat, and then it can tell us that it is a cat. What if we do step 2 again, where we use a machine to predict or to recognize what it sees for facial recognition or driverless cars? But in this case, instead of showing it a cat, we show it a dolphin and we ask the machine, is this a cat? The machine will try to look for the pointy ears or the whiskers, but it doesn't see any. It'll then be able to tell us that it is not a cat because it's not seeing the characteristics of a cat. Now, how about using machine learning for asset management? Here we perform step 1 again, where we train the machine and the machine learns. But here instead, we'll show it financial data. We can show it as long a history as we want for example, the various X's, the valuation metrics. They could be price earning ratios, or say leverage, debt divided by EBITDA, where EBITDA is a proxy for cash flow. Economic growth, GDP, interest rates, the 10-year US Treasury yield. On the Y, we can show it asset prices. They could be stock prices or bond prices or prices of currencies and commodities. The machine will continue to learn as it goes through, it could be millions of observations of each of these X's and Y's as historical data. The machine continues to learn and stores those alpha and beta coefficients. Here in step 2 then, the machine has the alpha and beta coefficients stored. It knows when asset prices go up or down based on those various X's, the various metrics that we've fed to it. Here then we can use a machine to start making trades. Each new X statistic that comes in real time, new price earnings ratios, new leverage, new debt to EBITDA ratios, new growth metrics for the economy, GDP, the machine can use towards assessing whether to buy or sell an asset. And again, this can apply to any asset class, stocks, bonds, currencies, or commodities. Now imagine this is always on. Step 2 is always on. That means the machine keeps collecting new data in real time, day in, day out, as they come in, and can decide whether to buy or sell the asset. But even more, imagine step 1 is also kept on, where the machine continues to learn and recognizes new patterns and adjusts those alpha and beta coefficients as time goes by, thereby improving its accuracy and doing this in an unsupervised manner. This is a lot of power that we can harness. Here's a second of the 3 cartoons I'll be showing you. I just got married this time last year and I'm still getting the hang of this. Many of you being skilled investors can probably tease out what the benefits of using machine learning for investing are. And they can be quite huge. Enhancing alpha, better systematically discerning alpha versus beta than a human can, recognizing more patterns than we can, reducing human error, reducing fat fingers, for example, learning faster than humans, and it can apply to literally any asset class, stocks, bonds, currencies, commodities, which is why Ray Dalio, the founder of Bridgewater, one of the biggest hedge funds, said recently that he believes 40% of all jobs in financial services are going to be replaced by algorithms over the next 20 years. Now, not to worry, the financial services industry is very broad. This is not just asset management. This includes transaction processing, banking, insurance, tax services. And we are seeing machine learning jobs on the rise. So we might surmise that a lot of these people that get displaced might become machine learning trainers, where they set up the machines and train the machines. Now, one last point we want to make here is we believe that jobs that require client interfacing, management, jobs that require advice, consultation, personality, jobs that require personal human touch, for example, should be safe. Jobs such as consultants or board trustees and staff. While those benefits from machine learning for investing sound great, better alpha, learning faster, machine learning for investing is not without its obstacles. There are key characteristics that differ between using machine learning for speech recognition, facial recognition, for example, on the left, versus using machine learning for investing. First off, the patterns are stationary when it comes to facial recognition or driverless cars, for example. The right versus wrong is always static. A person's face is always going to have 2 eyes, a nose, and a mouth. On the right, financial data, the financial markets, is always non-stationary. Patterns always move about. The right and wrong is always evolving. Case in point, price earnings ratios until now have averaged in the teens. Today and going forward, they've been in their 20s. The interest rates have changed over time. For example, the 10-year Treasury yield back in the early 80s, because of the oil crisis, was roughly 15%. Today, it's about 1.58%. So these relationships are always changing in the financial markets. The second is for facial recognition, for driverless cars, there's a high signal to noise ratio. Even with a blurry photo of someone's face, you could pick out the 2 eyes, the nose, and the mouth, for example. For machine learning for investing, there's a lot of noise in the markets where it can clutter the signal, making the signal very low. Who's to say that we should use price earnings ratio for valuations? Or should we use price to sales, price to book, or enterprise value to EBITDA? Who's to say we should use just the US GDP for economic growth? Should we use world GDP? Should we consider China's or Japan's GDP? And then lastly, there's no market competition when it comes to facial recognition or driverless cars. Whereas in the financial markets, there's tremendous market competition that whittles away at any alpha that can be found. Now, how has machine learning done so far? Very well, in fact. This index, the Eureka AI Hedge Fund Index, includes only about 10 funds. It's a relatively new index, so it's a small sample, but it's been showing quite well with returns better than the S&P 500 representing stocks and the AG representing bonds, and better efficiency, better Sharpe ratios versus both stocks and bonds. In the bottom, we could see that the blue bar for the AI Hedge Fund Index is quite volatile, however. Witness in 2010, it's very high returns, and in 2018, negative returns. However, we can see that there's relatively low correlation versus stocks and bonds, which bodes well for it to be a potential diversifying asset class for portfolios. Now, a caveat here I want to mention is the AI Hedge Fund Index is not investable, and it's not representative of all machine learning funds in the universe today, because it really is the wild, wild west. There are lots of machine learning strategies popping up seemingly every day. Here in the top left, we have large hedge funds that are already using machine learning for investing. Firms like AQR and Citadel have large teams of PhDs that are using machine learning for shrinkage methods that fight against overfit or to develop better covariance matrices. However, we want to proceed with caution in this space. A firm called Sentient Investment Management that was founded in 2016 and used machine learning was liquidated in 2018. They had a genetic algorithmic approach where they had multiple virtual trader bots, each that they considered like a gene that evolved and grew, and the ones that were unsuccessful, they discarded. As a next step, we expect more and more mainstream asset managers to begin using machine learning. A case in point here is Eaton Vance, a firm that I personally did a due diligence on-site session at in Boston just a couple of months ago. Eaton Vance, for their municipal opportunity strategy, is already using machine learning, where they have a system that scours all 50 states, all the newspapers for all the municipalities, the cities and counties of all 50 states. It reads through that and uses natural linguistic processing to discern any buy and sell signals for local water authorities, bridges and ports, for example, to make trade recommendations. Now here's a third and last cartoon I'd like to show you. A lot of us have smart speakers at home, and we have this at home all the time. We tell Alexa to play classical music, and of course it plays classic rock. Things got a mind of its own. This really is only the beginning. It seems like every day new research is being released on return forecasting using machine learning, for example, or risk modeling using machine learning, or natural linguistic processing using machine learning. And a lot of investments are being put into this space. Steve Schwarzman, the founder of Blackstone, one of the largest private equity firms, recently was an anchor donor of altogether $1 billion to MIT for machine learning and AI. Now, here are key takeaways that I'd like to leave with you. The overarching theme is that machine learning is becoming a very important part of asset management and bears watching and should continue to become even more important going forward. It's big data, as we saw earlier, that's making machine learning possible. Machine learning, at the end of the day, is just regression. And since you as investors know about regression, you know at a very high level how machine learning works. Machine learning could achieve better alpha, faster, and with fewer errors than humans can. But there are obstacles along the way. Those non-stationary data relationships I talked about earlier, the high noise versus signals, the competition. Next, this is the Wild West. We want to proceed with caution if we want to invest in this field. Machine learning is just starting to be used by managers in different ways. And the future trends are, we expect more and more managers to incorporate this into their standard processes and to launch dedicated strategies using machine learning and potentially overcoming those above challenges. Thank you for listening, and please feel free to reach out to us at Marquette, any of our consultants or our research team if you have any questions. Thank you.